Okay, so let's dive straight into something that's definitely been capturing a lot of headlines lately, the U.S. Treasury market.
Yeah, absolutely.
You've probably seen all the chatter. What are Treasury yields really signaling about the economy right now?
It's absolutely the place. A lot of sophisticated eyes are fixed. The bond market, especially treasuries, often seems to have this read on things, maybe
Mm.
before it filters elsewhere.
Right, that market that supposedly knows something.
Mm-hmm.
And for this deep dive, we're going to take a specific angle. We're looking at the perspective from a particular source we found really insightful, a YouTube video called Warning, Treasury Yields Are Signaling Something Big.
Yeah, it presented a really interesting counter narrative. So, our mission today is really to unpack their argument, figure out what this source believes the treasury market is truly signaling.
And understand why that interpretation is just so different from what you might be hearing elsewhere.
Yeah.
Because here's the twist, and this is where it gets, I think, genuinely fascinating. The warning this source points to isn't the one you might expect.
Hmm.
It might actually be the opposite of that popular narrative floating around.
It really highlights how, you can look at the very same data point and come to vastly different conclusions. It all depends on your framework.
Okay, so let's anchor this.
Mhm.
Let's start with a recent event the source uses to kick things off. We just saw the April CPI report come in,
All right, the inflation numbers.
and it was a bit softer than many expected, wasn't it?
Yeah.
Under 2.3% when forecasts were like 2.4% or even higher. Some people were expecting tariffs to maybe push it up.
Yeah, a downside surprise, basically.
Hmm.
Now, traditionally, when you get softer inflation data like that, conventional wisdom suggests, well, that should lead to lower interest rates, right?
Mm-hmm. Less pressure on the Fed, maybe signs of cooling.
Exactly. Less pressure, maybe the economy's slowing a bit. That should intuitively mean lower yields, especially on longer-term bonds like the 10-year Treasury.
But that's not what happened. That's the surprising bit. The 10-year Treasury yield actually rose after that soft CPI report. It pushed up over 4.5%.
Right, and that divergence, that's what really sent ripples through the commentary world.
And the interpretation you likely heard everywhere went something like this. Whoa, this rise is a huge red flag.
Yeah, the bond vigilantes are back.
Exactly.
Yeah.
Pushing yields higher to protest, out of control government spending, the blooming debt.
But maybe it means the bond market is like losing faith in the Fed's ability to control inflation or long-term rates, that kind of thing.
And this mainstream narrative, as the source describes it, well, it sounds pretty convincing on the surface, doesn't it?
It does. You think about the numbers.
Yeah.
The national debt is just enormous, over $37 trillion now.
Huge number.
And the government has to roll over trillions, literally trillions of dollars every year. We're talking, what, 10, 12 trillion dollars in annual refinancing?
Yeah, just staggering amounts.
So the argument follows. This creates a massive supply of new treasuries constantly hitting the market. And at the same time, demand is supposedly falling off a cliff. You hear about those bond vigilantes avoiding U.S. debt because of fiscal worries.
Right, or countries like China and Japan, big holders, supposedly selling down their treasuries.
Exactly. So you put it together, exploding supply plus collapsing demand.
Basic Economics 101.
Right. Prices should go down, and yields which move inversely to price should go up.
And the really scary part of this view is that potential doom loop idea.
The fiscal death spiral.
Yeah. Higher yields mean the government's interest payment on all that rolled over debt get even bigger, right? Which swells the deficit further, requiring even more borrowing.
Which pushes yields higher still. It sounds like a feedback loop you can't get out of.
It does. And the fundamental assumption, the bedrock underpinning this whole conventional story, is that the sheer supply of government debt, the size of the deficit, that's the primary force determining where long-term Treasury yields end up.
That's the core belief, yeah.
Yeah.
Supply is destiny for yields.
Okay, let's pause there, though. That assumption that supply and the deficit are the main drivers, it feels intuitive. Like you said, basic economics. More stuff usually means lower price, higher yield in this case.
Seems logical.
But what happens when we actually, test that theory against history, which is exactly what the source does.
And this is where it gets really interesting. Let's look at the 10-year Treasury yield over the long haul. Go back to the 1960s. Yields were, what, around 3.8%?
Mm-hmm.
They climbed dramatically through the 70s, peaking late 70s, early 80s around 15%.
15%. Hard to imagine now.
Right. Then they spent decades basically trending down, all the way to a low near 0.76% in 2020.
Almost zero.
Yeah. And recently, of course, they've climbed back up over 4.5% where we are now.
Okay, so that's the yield history. Now let's overlay that with the national debt, the supposed supply driver. In 1980, when yields were peaking near that 15%, the national debt was about $877 billion.
Okay, under $1 trillion.
Today, with yields much, much lower than 15%, the debt is over $36 trillion.
36 trillion. Just think about that for a second.
Yeah.
The national debt is over 36 times higher today than it was when yields were at their absolute peak.
Wow.
Yet, over that exact period where the debt absolutely exploded, long-term Treasury yields plummeted from 15% down below 1%.
That's a pretty major disconnect if supply is supposed to be the main thing driving yields, isn't it?
It's a staggering disconnect. And you can look at it relative to the economy, too. Debt to GDP ratio,
Right.
about 31% in 1980. Just before 2020, it had soared past 121%.
Quadrupled, basically.
Yeah, debt relative to the economy quadrupled, but yields collapsed over that same period.
And the deficit as a percentage of GDP.
Well, it's definitely higher today, around 6.2% compared to maybe 2.5% in 1980. But again, you look at the historical chart, there's just no consistent pattern where yields mechanically rise simply because the deficit is bigger relative to GDP. The long-term trend just doesn't really support the idea that deficits or total debt are the primary determinant of long-term rates over decades. Often it looks like an inverse relationship, actually.
So this historical comparison, which the source lays out really clearly, it seriously challenges that core assumption.
It really does.
It suggests that, okay, maybe over the long run, the sheer volume of treasuries, the total debt, the deficit, maybe that isn't what's fundamentally setting long-term yields.
The intuitive supply-side argument, while popular, just doesn't seem to square with decades of actual market data.
Which leads us to the crucial question the source then pivots to. If supply isn't the main driver, what is?
Exactly. And the source argues, quite compellingly, I think, that what does show a really strong, consistent correlation with long-term Treasury yields is something called nominal GDP.
Okay, nominal GDP. Let's just break that down simply for everyone listening. What exactly are we talking about there?
Yeah, good question. The easiest way to think of nominal GDP is it's the total market value of all the goods and services an economy produces in a year, but measured using the prices at that time.
Okay.
So it captures two things together. Real economic growth, are we actually making more stuff?
Right.
And inflation are the prices of all that stuff going up.
Got it. So it's like the economy's total output in current dollars.
Yeah.
Growth plus inflation.
Exactly. It's basically the top line figure for how fast the economy is growing in dollar terms.
All right. Now, how does that correlate with yields historically?
Well, the source lays out this correlation really clearly. If you look back at the 1960s and 70s again, nominal GDP growth was accelerating pretty significantly back then. It climbed from maybe around 1% up towards 15% by the late 70s.
Okay.
And guess what the 10-year Treasury yield did? It followed that trend almost perfectly. It rose right alongside nominal GDP growth expectations, peaking near 15% around the same time nominal GDP growth did.
Wow. Okay. So they moved together on the way up. What about on the way down?
Same story, basically. From 1980 onwards, the economy entered a long period of, well, generally lower inflation and slower nominal GDP growth. It dropped from that 15% peak down towards, say, roughly 5% before 2020.
And the 10-year yield?
Trended consistently downwards right along with it,
Yeah.
from 15% down below 1%.
Following nominal GDP down.
And importantly, since 2020, with the surge in inflation and a rebound in economic activity, nominal GDP growth has picked up again.
And yields have risen again.
Precisely. So the core argument from this source is that long-term interest rates, like the 10-year Treasury yield, they're primarily a reflection of the market's collective expectation for future nominal GDP.
So what investors think the combined rate of growth and inflation will be, say, over the next 10 years, the market is pricing in its forecast.
Exactly. It's forward-looking.
Okay. So if yields are mainly tracking future growth and inflation expectations, future nominal GDP, then what is the market really warning us about with this recent rise in yields despite soft CPI and just the generally flat yield curve we see? According to this view, it's not the deficit doom loop, is it?
No, exactly. Based on this analysis, the Treasury market is signaling something big, but it's fundamentally the opposite message of that simple supply deficit narrative.
Opposite how?
It's not about a lack of demand for treasuries because the government's spending too much. It's actually about demand being driven by something else entirely, by risk perception.
Okay, this is where we need that analogy the source uses.
Yeah.
It helps understand the mechanism behind this, right? The Banker Bob analogy.
Yeah, Banker Bob. Let's unpack that.
Okay.
So Banker Bob represents like a large financial institution, think a big bank, a pension fund, an insurance company, someone with access to lots of capital.
Okay.
Bob can borrow money pretty cheaply, let's just say at 2%. His whole job, basically, is to deploy that capital to make a profitable spread.
The spread being the difference between what he pays to borrow and what he earns by lending it out or investing it.
Exactly. Make money on the difference.
So Bob has choices for where to put that borrowed money. He could lend it out to the real economy, right?
Yeah.
Fund businesses, make loans, finance projects.
Real economy lending. And the potential return there might be higher. Maybe he can get 6% lending to a corporation. But there's
Sure.
risk. There's risk. There's a real chance he might not get all his money back. The company could struggle. The project could fail. Someone could default.
Okay, so that's one option. What's the other main one?
His other main option is to just buy a U.S. Treasury bond. The yield might be lower. Let's say it's 4%.
Less than the 6% from lending.
Right. But it's considered the safest asset on the planet. The risk of the U.S. government defaulting is, well, negligible for practical purposes.
Okay, so higher potential return with risk or lower return with safety. How does Bob decide? Does he just automatically chase the higher 6% yield?
Not necessarily, and this is the key. His decision, according to this view, is primarily based on his assessment of future risk and his expectation for future economic conditions.
Ah, so it's about his forecast again.
Yes, particularly future growth and inflation, future nominal GDP expectations, and maybe just general uncertainty or stability. If Banker Bob looks ahead and sees, storm clouds gathering, maybe a potential recession, maybe instability, maybe really unpredictable inflation,
He gets nervous.
he becomes much more risk-averse. And in that scenario, safety becomes paramount.
So even if lending to that risky business offers 6%, the 4% from a treasury suddenly looks much more attractive.
Absolutely. Because he's highly confident he'll actually get that 4%.
Yeah.
He's more concerned with preserving his capital and locking in a definite safe return than he is with maximizing the potential yield if it comes with too much uncertainty.
So he'll happily take the smaller spread. Like the 4% treasury yield minus his 2% borrowing cost gives him a 2% spread. He takes that safe 2%.
If he thinks the risk in the real economy, where the 6% yield lives, is just too high to justify chasing that extra potential return.
Right.
But if he looks ahead and sees clear skies, strong future growth, manageable inflation, high future nominal GDP expectations, then he's much more willing to take that risk and lend to the real economy to capture that larger 6% return and the bigger spread.
Right, this is the critical point the source is making, isn't it? When all the banker bobs out there collectively see high future risk or anticipate lower future nominal GDP or just feel a lot of uncertainty,
They pile into treasuries for safety,
and their massive dying pressure actually pushes treasury prices up.
which in turn pushes treasury yields down. Or at least it prevents yields from rising as much as they otherwise might relative to rates on riskier assets.
Okay. And when they're confident in lending to the economy.
Demand for treasuries is lower, yields might drift higher, reflecting those better growth expectations and lower perceived risk. Yields follow the risk growth outlook.
And what about that arbitrage point? You mentioned Bob borrows at 2%.
Right. This is key to understanding why high debt levels might not automatically mean runaway yields. Banker Bob isn't usually investing his own cash where inflation erodes the return directly. He's using borrowed money.
So he cares about the spread.
He cares about the spread. If he can borrow at 2% and buy a treasury yielding 4%, he's locking in a 2% spread on potentially billions of dollars. Hugely profitable, even if inflation is, say, 3%. He's still making money on the transaction itself.
And the source uses this to counter that supply argument, right? If the government suddenly issues a ton more debt, maybe temporarily pushing treasury yields up to, say, 5%.
Banker Bob and his peers don't run away scared because of too much supply. They see a bigger opportunity.
Because now the spread is even better.
Exactly. A 5% yield minus their 2% borrowing cost is now an even juicier 3% spread for essentially zero credit risk. They'd likely buy more treasuries to capture that bigger, safe profit.
So their demand for this profitable, safe arbitrage would actually help bid yields back down.
It would push them back down towards whatever level is consistent with their underlying view of future risk and growth expectations. This is why, according to this source, the demand side, driven by these risk and growth assessments, is much more powerful in setting long-term yields than the raw supply figures.
Okay, that makes sense. Now, let's connect this banker-Bob dynamic, this demand for safety idea, to the current chase of the yield curve. It's pretty flat, right? Short-term rates are very close to long-term rates, sometimes even inverted.
Yeah, the Fed funds rate isn't far off the 10-year yield, or sometimes even higher.
Now, in that conventional supply-side view, A flat or inverted curve might be seen as, what, a lack of demand for long-term bonds. People aren't willing to lock up money for 10 years.
That could be one interpretation, yeah.
Yeah,
But the source argues it's precisely the opposite.
the opposite, so too much demand.
Exactly. According to this perspective, a flat or inverted yield curve isn't a sign of weak demand for the long end. It's a sign of very strong demand for the long end, specifically for its safety. It means banker Bobs and other large investors are so concerned about future risk in the real economy that they are crowding into long-term treasuries for safety, even if the extra yield they get compared to just parking money in short-term, safe government paper is tiny or non-existent.
So they're prioritizing safety over getting paid much extra for taking duration risk.
Precisely. They are demanding that long-term safety so much that it pushes the long-term yield down close to the short-term yield.
The source used a metaphor for this, didn't it? Something about a car engine.
Yeah, that was a good one. Think of the economy like a car engine. When the yield curve is steeply upward sloping, long yields, much higher than short yields, that's like the engine smoothly accelerating.
Okay.
Investors are confident, they're willing to lend money to the engine, the real economy, for longer periods, taking on more risk because they expect a good return down the road as the economy grows.
Makes sense. So what's a flatter inverted curve then?
That's like the engine is just idling, or maybe even sputtering a bit. It signals that investors like Banker Bob are actually pulling back from lending to the engine. They're hesitant to fuel the real economy because they perceive significant risk ahead.
So they'd rather just sit on the sidelines.
They'd rather just sit safely in long-term government debt, basically idling, because the perceived safety is more important right now than trying to get a higher return from a potentially troubled real economy down the road.
Wow. Okay. So pulling this all together, the real warning signal coming from the Treasury market, according to the source we're diving into, it isn't about too much government debt overwhelming the market.
No.
It's that the market's strong demand for the safety of long-term treasuries, which is reflected in that flat or inverted yield curve. That demand is actually a collective prediction by these big financial players.
A prediction that there's significant risk lurking ahead for the real economy.
They're seeing potential for slowing growth, maybe instability, maybe unpredictable challenges in the future.
And that's prompting them to seek refuge in safe government debt now.
So it's a signal driven primarily by anticipated future conditions and perceived risk, not just a simple reaction to today's deficit numbers or Treasury auctions.
That's the core argument, yes.
All right. So let's bring this back home, bring it back to you, the listener. Why does this different perspective on Treasury yields actually matter? Why should you care about Banker Bob?
Well, I think it matters because it fundamentally changes how you might interpret those headlines you see every day about the bond market.
Okay.
Instead of seeing rising yields or a flat curve and immediately jumping to the deficit doom loop explanation.
Which is easy to do.
Very easy. It's everywhere. But understanding that these movements might primarily reflect market expectations about future growth, future inflation, and crucially perceived future risk. That gives you a much deeper insight. Arguably a more accurate one.
So it lets you see that the bond market isn't necessarily screaming about government spending levels right now.
It might be whispering or maybe even shouting quietly about the future health and stability of the underlying economy itself.
Based on what the really big, sophisticated players are actually betting on with their actions.
Exactly. It's a signal driven by collective foresight and risk assessment. And that's powerful information to have regardless of how you invest or plan.
Which leads us to our final provocative thought for you to maybe chew on after this. If the bond market, through this strong demand for long-term treasuries and the resulting shape of the yield curve, if it is truly signaling high future risk and uncertain growth expectations for the real economy, what potential forms could that volatility or those challenges actually take down the road? Especially if, current economic data still looks relatively stable on the surface today.
That's the million-dollar question, isn't it? What exactly is the market bracing for? Something to really ponder.
Definitely something to chew on. Well, that's been our deep dive into what the Treasury market might really be telling us based on this particular source's really compelling analysis.
Yeah, hopefully this gives everyone a new lens, maybe a different angle to view those bond market charts and headlines going forward.
We hope so. And hey, if you found this deep dive valuable, please do take a moment to follow, like, and share it with anyone else you think might find it interesting.
Yeah, that really helps us out.
And of course, you can always follow What Bitcoin Taught Me for more insights like this on, well, all the platforms: Twitter X, Nostr, Bluesky, Threads, Instagram, Facebook, and LinkedIn.
We appreciate you tuning in.
We really do. Thanks for joining us, and we'll catch you on the next deep dive.